right, we're going to go ahead and get started since it is a little afternoon. Thank you everybody for coming. We're very happy to have you all here. As you may or may not know, the insurance world is changing very rapidly. And when you add wealth and high net worth into the equation, there's even more changes going on. So we're hoping that there'll be some good information imparted to you all today. I am happy to, my name is Wes Kaufman, by the way. I'm one of the partners at Heartwood. I think everybody here probably knows me. I'm the bald one, knows me. But happy to have with us Bart Dalton. Bart is with McGriff Insurance Services here in town, specializing in helping high net worth people insure risks across their portfolio. We've done a fair amount of work with Bart over the years, and he's been a good partner to Heartwood. So glad to have him here today. And then we've got also Rachel Williams. Rachel is a senior business development executive with Chubb here in town. Chubb Insurance Services. Probably everybody's heard of Chubb one way or another. Bart actually, his firm works with several high-end insurance lines, and Chubb is one of the main partners that they work with. So we're happy to have Rachel with us as well. She is local, lives here in Richmond, and brings a lot of experience in this space. So we're going to do things a little different today. What we're going to do is we have curated some questions that we think people will be interested in hearing about. So we're going to start off with that and get Bart and Rachel's take on some of these things. And then as we go through this, we'd like to just keep this pretty informal. So as you all have questions that come up relating to anything that we're talking about or anything that you want to know, please let us know, and we'll just roll like that. So without any further ado, let me get into the first question we've curated here. So this is for both of you guys, and you guys can figure out who wants to lead off with this. But what are the typical challenges or potential problem areas you see when you first begin working with a new high net worth client? And if you could, provide some specific examples.
Yeah, absolutely. So I'll start off and then pass it off to Rachel. Again, it's good to be here this morning or this afternoon. I've met several of you already. I'm Bart with McGriff, and definitely specialize on the personal side with high net worth. And it's a really good question to lead off with. What are some of the challenges when we meet a new client who's considered high net worth, who have several homes or nicer cars, who might need a little bit higher liability than what's afforded in what we would call the middle market carriers like State Farm, USAA, things like that, who've outgrown their current carrier and who are looking for more appropriate coverage. What are some of the challenges? And it happens over and over. One of the biggest challenges is just to understand that all carriers are not the same. That is one of the biggest things we have to talk about at the very beginning. So a lot of us are trained because we watch TV and we see commercials. We can save you 15% on car insurance, or 15 minutes can save you 15% or more. And for people who don't have a really good understanding of how personal insurance works, that sounds like a really good plan. But what they don't say is how are we saving you on rate? How are we saving you on the premium? And that's by cutting coverages, cutting services, and being a little bit harder to work with. So one of the challenges is talking about how carriers like Chubb and Pure and other really good high net worth carriers, it's the difference between night and day. These are carriers that are specifically designed to work with clients just like you, nicer homes, nicer cars, need higher levels of liability, and the coverages work very differently. The service is very different. The claims experience, again, difference between night and day. So for example, yes, for some examples, when you're working with a carrier like Chubb as opposed to a carrier like State Farm, it's been our experience that a lot of clients that come out of State Farm into a carrier like Chubb learn that a lot of times State Farm will look for reasons not to cover a claim. If something happens in your home and you reach out and you say, hey, this has happened, they'll say, well, it's in our policy that this is not covered and we're really sorry. But when you're working with a carrier like Chubb, they look for reasons to cover the claim. And so, for example, we had a client years ago who noticed on their wall in their bathroom there was a growing mark. They became concerned, and so they called and they put in a claim. The contractor came out and opened up the wall, and they saw that it was wood rot all inside their bathroom wall, wood rot everywhere, and it was a really big mess. There was a leaky pipe for a long time. Now there's wood rot, and so you won't find a home policy that covers slow water leak. That's just not covered. Most home policies, they cover like a water pipe that breaks or a lightning strike, an incident that happens, not wear and tear. But Chubb, we went to Chubb, we said, hey, they have this claim, this concern. And so Chubb read in their policy, they found a loophole in their own policy that said that the policy will cover whatever damage the contractor has to do to the wall to find the problem. And so Chubb told the contractor, just keep damaging the wall. Just keep hitting the wall, knocking all the wood rot, getting it out. And so that's exactly what the contractor did. The claim was covered, and Chubb paid for the wall. The client paid for the leaky pipe, and it was put back to normal, and everything was great. And so just the basic understanding that there's a very big difference between working with a middle market carrier and working with one of the high net worth carriers is one of the challenges.
Anything to add to that, Rachel? I mean, that was pretty comprehensive.
Yeah, that was pretty
comprehensive.
Yeah, we can
Okay.
move on to the next one.
So lots of things are changing in the world, and I'm sure the insurance industry is the same. So what are some of the major challenges you guys see in the property and casualty world that are going to start to impact consumers that are coming forward?
Do you want to?
Yeah.
We have some slides on this. So this is where I come in with some great information.
Do
If
you
you
wanna
can't
move
see
over?
this yet, let me know. I can also stand up. So this might be more information that you came here for today, but our passion at Chubb is to help you utilize risk management to protect your assets. So we want to help your financial advisor be able to maintain and grow your wealth and ensure that any insurance loss does not impact their ability to do so. Unfortunately, though, the industry right now is going through a number of challenges that are impacting not only rates across the board for personal insurance, but also capacity. So capacity and the ability to obtain coverage and the right coverage in the areas where you need it. So you guys may have seen a lot of news articles lately around insurance. We don't always get top billing in the insurance industry in publications or newspapers, but we have been over the past year. And that's because it's really become an issue for you all as well as for us. And so there's a number of pressures creating kind of downforce pressure on the industry. And if you can go to the next, if you want. Yep. So these are the challenges right now that are currently impacting the industry, but also we foresee continued impact into 2024. And I have some, it's a lot of information here, but primarily it's the changing weather patterns and more extreme storms. This is causing a lot of pressure on loss costs for the industry. Unfortunately, we've already exceeded the record in 2023 for the number of catastrophic events. So we define catastrophic events as events that pay out at least $1 billion or more for that particular, in covered insurance losses for that particular event across the industry. So and this actually needs to be updated. As of this morning, we've had 24 events in 2023 that have exceeded $1 billion in payout. So this is paid out by the industry and causing loss cost pressures.
This is nationwide.
Nationwide, absolutely. So yes, unfortunately, what happens nationwide can affect us in our local market too. So that's something that we're trying to grapple with, and these are just those events over $1 billion. That's not even notating those that are under $1 billion that are still natural catastrophes. We also are seeing increasing flooding due to these changing storm patterns, increased construction and development, and also the rising sea levels. Flood is going to be one of the next issues in terms of emerging risks that we're finding that we need to find better solutions for. But this is going to be an increased exposure for most homeowners, and your homeowner's policy itself does not cover flood. So that's going to be something that a lot of people are going to have to look for coverage for. Okay. Outside of weather-related events that we hear about, another, pressure that we have on the industry is non-weather-related water losses. So plumbing-related failures. We see a lot of this now. Our homes are bigger. We've got more than one bathroom in our homes. So we're seeing a lot of plumbing failures, and that's causing a lot of damage. The average plumbing-related covered loss exceeds $80,000 in the high net worth space. Not only that, but it takes away time, energy, and that's money to you all. So it can be a big deal, but that's usually about 48% of overall claims paid out for any one carrier. Okay. We are seeing continued inflation pressures for the cost to rebuild homes after a covered loss. While it has come down from the peak in 2021, 2022, it is still up double digits over what it was a couple years ago. So that means that insurance carriers are paying out more money to cover your loss. And that's more money that comes out of what is paid out for claims. So because of all of these lost cost pressures, carriers are struggling with reinsurance. So every carrier utilizes reinsurance for their business. This allows us to maintain more dollars for investment, more dollars to pay claims, but it depends on how much reinsurance each carrier utilizes and how they operate their business. Reinsurance is basically insurance for insurance carriers, if you want to think about it in that way. So because of the issues going on in natural disasters, water losses, we're seeing increased rates for reinsurance, and so that's causing carriers to have to reevaluate how much reinsurance they can buy, and then what capacity they're able to take on for future losses and future insurance new business coverage.
Let's ask for questions.
Yeah. Does anyone have any questions at this point? Good idea.
You're coming up on mine.
Oh, okay. Okay. Don't stop short.
So because of the pressure on reinsurance and reduced capacity from reinsurers, that's also therefore reducing capacity for the carriers themselves. So carriers have to make strategic decisions on whether or not they can write wind coverage in Florida, whether or not they can write homes in California, because they're not able to obtain that extra layer of protection in the reinsurance world. So a lot of decisions. Another interesting fact about the pressures on the industry is the undervalued dwelling limit of homes. And so this is really affecting middle market carriers. And what this means really is that for years, insurance carriers were insuring homes for less than what it now costs them to rebuild the home in the event of a loss. So market value is very different from rebuilding costs for many reasons. But historically, they were insuring homes for much less than what it would cost them to rebuild, and they weren't getting the premium that they needed in order to fully cover that loss in the event of a partial or total loss. So now we've got reinsurance carriers looking at a portfolio of business, seeing that these homes are underinsured, and being very squirrely about whether or not to offer the reinsurance to cover what is needed by that carrier, and or declining to offer coverage. So now insurance carriers are having to up the dwelling limit on your policy to an adequate level based on their calculations and claims data in order to build up that portfolio. So you're seeing that, like carriers like Allstate, Liberty Mutual, they have increased their dwelling limits by 25-30% for everyday homeowners just to get their values up to speed.
So my question is this: do you see in the future an industry trend to reduce the percentage, replacement cost up to X percent above? Do you see that X percent going away, or how else do you see them dealing with that issue?
Great question. So when we've gone through cycles similar to this, we have seen that inflationary measure get lowered. And then, we get through another cycle and it goes back up. Currently, in the next 2 years, I do not see that going down. In fact, it will likely continue to go up. So unless there's a difference in supply chain or inflation on building materials, skilled labor, we can get a pipeline of skilled laborers within the U.S., I don't see it going down anymore.
We
anytime soon.
I agree that the replacement cost is only going up, and so to me, it only makes sense for the insurance company to limit their risk by limiting how much they're willing to give you. So explain to me how it's not in the insurance carriers or brokers' interest if you can't afford to rebuild your house, you know, because they're not out the mortgage or the loan.
Yep.
So why are you motivated to pay 40% more than my coverage?
Yeah, no, that's a great question. I think to your first part of that, that's going to be the next step, is limiting the actual amount of coverage on your policy. Some carriers already do that, and that would be kind of a middle market focus where they limit what they're going to pay out in the event of a loss, and it's dictated in the contract. Or high net worth carriers, similar to Chubb, where we have a guaranteed replacement cost where we don't limit it. But we are seeing on both sides of the insurance carrier world that we are limiting more and more of that, modifying contracts and even utilizing excess and surplus lines coverage to have that dwelling limit at a fixed amount. So I do see that happening more and carriers utilizing it more.
Yeah, absolutely. And let me speak to that really quickly, because we've mentioned this a few times about replacement cost on your home, and you want to make sure that your home is insured for its replacement cost. Because if you think like an insurance carrier, if they're going to insure your home, if there's a total loss, let's say a tornado comes to your neighborhood and damages your home beyond repair. So what do you want the insurance company to do? What they're going to do is pay someone to tear down the structure, dig up the foundation. They're going to pay someone to remove all the debris and pay someone else to store it. And then they have to prepare the ground and then rebuild your house exactly the way it is right now with all the upgrades you've added to your home, with all the nice things you've added in your home. You want all that replaced, except it's all going to be brand new. Brand new roof, new plumbing, new electricity, everything built up to code. And so when you set the dwelling value on your home, you want to make sure that your home is insured for the replacement cost, not the market value. It happens often where a client will say, I just purchased this home for $1.5 million. I'd like for it to be insured for the $1.5 million. But in fact, it would cost more than that to tear the house down and then rebuild it brand new. So the insured amount of the house might be more than the market value, but that's exactly what you want. And if you, I don't know who your personal insurance is with now or how often you actually read the 35-page document. If you scroll all the way down to the very bottom of your home policy, if you're with one of what we would call a middle market carrier, there's a line at the very bottom that says these coverages are an estimate of what we believe your home is worth. But if it's off, then you're responsible for the extra, which means if your home is not insured to value and there's a total loss, then they're either going to rebuild a lesser home or you're going to have to come out of pocket of your own managed funds to rebuild your home back the way you want it to be. But with a carrier like Chubb and other premier carriers, they offer something called guaranteed replacement cost. And what that means is they're going to rebuild your home regardless of the limit. So if we buy the $1.5 million home, Chubb says we think it's $1.5 million, but let's just say because of labor and lumber and shortage of supplies and all those things, it's actually $3 million. Let's say that's the actual cost because of unforeseen things. Chubb will pay the $3 million, okay? And then another really good thing about that is that if you have a home claim that exceeds $50,000, okay, if it's a really big home claim, a kitchen fire, whatever, big home claim, Chubb will waive your deductible and you pay 0% of the claim. Okay, and so it's basically coverage without limit, and that's one of the things that distinguishes high net worth carriers from the middle market carriers.
Great.
So let me ask a question, answer questions.
Can you repeat, kind of recap the questions from in terms of the Zoom participants can hear it over the mic?
Yeah, sorry. Yeah, we'll do that. So the question was basically, how do the insurance companies figure out how to insure it at a level, or what's their motivation basically for replacing it if it's not insured up to that level? And basically the answer was they don't. They'll the middle market carriers will replace it to whatever level it's covered to, but that's all they're going to pay. Whereas higher end carriers will have what's called guarantee replacement. Now, one thing maybe going through everybody's mind here, which would be going through mine too, is, geez, that sounds great. I'm clearly going to pay a whole lot more of a premium to get that kind of coverage, right? So maybe let's talk about that, and is that true? Is that not true? Or how would you answer that question? 'Cause I'm sure you get that all the time
Yeah,
too.
absolutely.
One other quick question before you. Can you define for us what a high-end market carrier is? Is there a dollar number on there in terms of value for real estate? Or, because I'm sure I'm with the middle market carrier now, and they're driving me crazy down in Florida. That's why I came to
Okay.
talk
Yeah.
about it.
Yeah.
The way we
A lot
define
of
it,
smiles around.
right? Yeah, sure. The way we define it at Chubb is we want to work with anyone who values coverage, service, and claims experience. We also have a dwelling limit, which is 500,000, but that can vary by state. But it's a very broad definition of who we want to work with, as long
So
as
your
the
minimum's 500.
500. Yeah.
Yeah.
But the way that this conversation, I think, affects you all is that when you have a carrier that limits the coverage, how does that affect your need to take out any dollar amount from any investment funds that you've allocated for other areas of need? And so that is our goal, is to make sure that that doesn't happen to you and that you utilize risk management to protect your wealth. So there are options. You always have options in the insurance world, and Bart is great at helping you work through those options based on your risk tolerance. But that's just kind of how we view it.
And we have seen rate increases this year and last year based on the factors that you talked about, Rachel. But what we do when we meet with our clients at the renewal, when their policies renew, we sit down and we say, okay, it looks like the rates increased because of all the factors Rachel talked about. And so let's look and see what we can do to make this manageable. Maybe it's changing the deductible. And in a lot of cases, what we've learned is if the client agrees to take on more risk yourself, like increasing your deductible, maybe going from a $2,500 home deductible or a $5,000 to a $10,000 deductible, then actually the coverage is the same, but the rate goes down and you're paying less per year for even more coverage, if that makes any sense. But, so in short, what we can do is we can look at all the options and we can make sure that you do have the best possible value for you. It's not just if you're working with a captive agent, then they can just say, this is what we have, take it or leave it, sorry. But when you're working with McGriff, we have all the options, we work in all the states, and we can say, this is what is available to you, this is what we recommend as the best value. Including Florida, including Hawaii, yeah, and the other bad words that we can say in insurance right now,
it's a
including
good-
Colorado.
Good segue into the next question, which is talk about where you're seeing problems for getting coverage in the high net worth space right now, and how are you solving those problems?
That's a really good question. So it's definitely challenging, and I've been in insurance for several years. I have peers who've been in insurance for 30 and 40 years, and they say we've never seen it like this before, where carriers are just leaving the market, where they're not writing in certain states, where the requirements are so much stricter than they ever have been before. And so the challenges that we have are a lot of our clients that live in Virginia like to have a vacation home. And the places where you like to buy homes are in these places that are hard to insure, like Florida, or like on the coast, or in Colorado in a fire area, or in California. And so those are some of the challenges that we have. The good news, again, McGriff, we're the 5th largest independent broker in the country. We have all the relationships with all the carriers, and we do a lot of business with them. So what we do is we utilize those relationships and we leverage that to help provide better service for our clients. For example, if you have a home in Florida and you've gotten notice, hey, we're not writing in Florida anymore, then you come to me and say, well, we would already know that, and we would proactively remarket your home in Florida, or find out what the restrictions are that are needed in order to keep that insurance policy in place. We've had clients that have had to install smart devices in their homes called the automatic water shutoff valve. Or we've had clients that have had to replace their roofs, unfortunately. We've had clients that, I have a client now I'm working with, he's a new client, he's an attorney in Gloucester, and family estate, $3 million plantation home built in the 1700s, and travelers dropped him with hardly any notice. And so he came to us and said, can you help? We have other properties and car collections and things like that. And so we were able to place his home, but what he had to do was rewire that home that was updated in the 1960s. Unfortunately, that's what had to happen in order for us to find coverage for him there. So just working in this environment with all the challenges, but having all the options at our hands and saying, this is what we need to do in order to find good coverage for you. Yeah.
Speaking of Florida, what exact things are you finding that the homeowners have to do if you're on the water?
Okay.
So, yeah, question was,
On the wa- I mean, not near the water, on the water.
On the coast.
question,
Not in the water.
yeah.
I'm
yet.
joking. I'm being silly.
Yeah.
Go ahead.
Question was, if you're in Florida and your waterfront property, what are some of the things you're seeing clients have to do in order to get coverage, if they can?
So homes on the coast, that is a very big challenge. And so we do have options for our clients whose carriers have left the market. We've had 20 carriers since the early 2022 that have left Florida or filed for bankruptcy. And I don't know if you've seen in the news, State Farm said, we're no longer writing homes in Florida. So people who were insured there for 60 years, they got a non-renewal notice. And then Florida said, actually, no, if you're gonna write car and umbrella policy, auto policies, things like that, you have to write the home as well. So they came back and said, okay, fine, we'll do the homes. And then there was the farmers backed out at that point. So even some of your like staple, I guess you could call carriers are leaving Florida. So what do we do to help our Florida clients? We just work with the options that we have. And we find out exactly what the new requirements are. If they have to replace a roof that has a wind mitigation, that meets the wind mitigation criteria for the carrier, then if that's the best option, then that's what we recommend.
Are you seeing that a lot, like roof, change your roof?
We are seeing that, especially like if the roof itself is, I think 10 years old or older. I know. Someone in Florida is making a roofer is making a lot of money in Florida for these insurance requirements. Storm shutters, they're requiring storm shutters or improved windows and glass cover openings in the home with like wind mitigation, impact glass, those types of things. Yeah.
I have a condo in Utah in a wildfire-prone area. It's a relatively small condominium regime. I think there are 27 units. Are there things that I can or should do to make that more insurable?
Why don't you talk about Chubb's wildfire stuff?
So let me repeat that
Yeah.
question. The question was, the gentleman has a condo in Utah in a fire zone, and are there things that can be done to that condo to help with insurance mitigation?
Condos are a challenge because you have other condo owners, and so making capital improvements can be challenging. So you want to understand, do you have sprinkler suppression systems? What is the wildfire plan from the association if they have one? But there isn't a ton you can do on a condo for wildfire. We have services at Chubb that address wildfire threats, but they're for standalone homes.
As you say, I mean, obviously there's a problem with, you got 26 other units.
Yeah.
And the surrounding building. But are there things, I happen to be on the board of the condo association, so if there are suggestions as to, so what could the overall association do? It can't move out of the fire zone, unfortunately.
Yeah.
They're not portable condos.
Things that it could do, does it matter how many units are typically rental units? Does it matter if there are fireplaces in the units?
No. The roof on the structure
Right.
is important. So you want to understand if you have a fire retardant roof or anything that can really stamp down on the embers that could, get into the gutters of the roofing system and spark the fire. That's one thing. The only other thing would be, how are you managing the vegetation around the property, and how are you pulling that out and making it so that it's not going to spark up in the event of a fire? Yeah, that is a very challenging situation.
All right. We're going to shift gears a little bit here. We're happy to go back to Florida or problem areas, but
Before you do, we never
Yeah.
got to that pricing question that you raised, the one that,
Sure.
for the increased value, which we all agree is worth more, but
Yeah.
what kind of pricing differentials are we talking about?
That's a great question. It is going to depend on your personal risk profile and where your properties are located. But honestly, in our experience, it's not that much more to upgrade to a premier carrier. you're going to have to level set. Is it worth it to you? Do you see the value? What are the services you're getting? But it doesn't have to be double, triple, quadruple. Like, it's really not. You look at the full bottom line. Sometimes people go for it. Sometimes they don't. But use your broker to understand what it is you're getting and how it's going to benefit you.
Yeah, I would say in our experience at Heartwood, that's been true. Like, premiums have been, when clients have come in and we've looked at their insurance and decided to make a change, premiums have, in most cases, been higher, but not a lot higher. And the level of service that you get is, you can make that decision yourself, but the level of service that people get seems to be, you kind of get what you pay for.
We recently evolved into a situation where our middle market carrier has our home insured with one company.
Right. Yeah.
Our farmland, the liability there is with a different company, and the personal excess policy is with yet a third company.
Okay.
Do the companies you work with cover that as an umbrella, or do you have to proceed in the same manner with patchwork?
Right. So the best plan is to have all of your policies
Bart,
with
you want to
the
repeat that?
Oh, yeah. Go ahead.
All right. Okay, so the question was, in a lot of situations, if you've got multiple things to insure, there are multiple carriers insuring them, so you're dealing with multiple different companies. When you have to get a claim for one thing, you got to go here or there, other place. The question was, in these situations, especially with a company like McGriff, is that the case? And if so, how do you deal with that?
So plan A is to have all of your policies with the same carrier and to have the same renewal date so that we can sit down every year, go over your coverages, what the renewal looks like, and to see if we need to make any changes, what we would recommend. Okay. It happens occasionally when a client with Chubb or another carrier, they have several auto claims. Or something will happen where Chubb says, unfortunately, because of the activity, we can no longer cover the auto. And so then we would have to go and look at other options for the auto for a time until those claims roll off and we can move back to Chubb. That would be plan A, to have everything together. But there's a lot of reasons why you would need to move around to different carriers. And the good thing is that we do have those relationships. So if for whatever reason Chubb or another carrier couldn't do everything, we would be able to place you with the different carriers and that sort of thing. But think about it this way in terms of a claim. Let's say there's an auto accident and you're named at fault, and someone on the other side is injured or worse, and then there's a settlement, there's a lawsuit, and there's a settlement. You're going to want to make sure that your auto policy and your umbrella policy are with the same carrier. That's really important, because if not, then what would happen in the process of that lawsuit is you would have a set of attorneys from your underlying auto carrier, and then a set of attorneys from your umbrella policy carrier that has your umbrella, and they would have to be working together along with you, and who's working on your side, who's making sure that your needs are being met. One of the really good things about working with a company like Chubb is that let's put the same situation, you're in that same situation, and Chubb has your auto and your umbrella. First of all, their limits are way higher. A lot of the underlying carriers have like a $5 million limit, but Chubb goes up to 50, and then they can also go up to 100 million. And so they can make sure that they offer the right type of coverage for the client and make sure they're properly covered. But also, Chubb offers your own personal attorney can shadow the case, and they can be right there with you, working on your side and working with the attorneys from Chubb in the whole process. So that's just the kind of next level service you get from a premier carrier that really puts the client first, the service for the client first, and understands that this is a personal issue. It's going through a lawsuit like that. So you want to make sure people are taken care of. Does that make sense? So really quick, it's better to have everything with one, and that's what I would recommend, even though it might be less expensive to bounce it around with other carriers.
Back to Florida again, there's a lot of uninsured motorists in Florida, and it's too bad for you. You're just driving along, and you're doing everything right, but they crash into you.
Yes.
I haven't had that, but my grandchildren have.
Oh,
So
okay.
what happens with that? Is that just your fault?
I have a great answer, but I'm going to let Rachel take that one.
So the question was if you get, especially in Florida, but any place, if you get in an accident with an uninsured motorist, what typically happens with these kinds of carriers?
It's no fault.
No fault, yeah.
And it's a no fault state.
It's a no
Yeah.
fault state.
Yeah, Florida is a tough, litigious state. So 35% of all lawsuits countrywide originate in Florida, but 35% of the US population doesn't live there. So it's a very friendly, litigious state, but also not very friendly to us. My recommendation, as I'm sure Bart would concur, is to get as much uninsured motorist coverage as you can purchase. Especially if you have exposure anywhere, because the uninsured motorist coverage is what actually protects you. So buy as much as you can. That's my recommendation.
And my clients, we have 500,000 of underlying policy, of coverage on the underlying auto policy, so $500,000. And then with the umbrella policy, which is there to cover your personal wealth if you are named in an accident or named in a lawsuit, also has a separate line of coverage, which is an additional $1 million of uninsured motorist coverage. So if you're in the hospital after you've been hit, someone hit you and they don't have coverage, or they're with Geico and they have $20,000, but that didn't even cover the the ambulance ride, to the hospital. You're there for weeks, you're racking up all this bills, then your insurance carrier will kick in and pay all of those bills for you, so you don't have to go into your managed funds while you're waiting on a lawsuit. Yeah. So you have up to 1.5 million. You can purchase more than that if you'd like.
And with most carriers, your umbrella policy covers you worldwide, whether you're in Virginia or Florida. If you are domiciled in Florida, the umbrella rates and the auto policies are very expensive for the exact reason that you mentioned.
So good segue into one of the next questions is, how much umbrella liability coverage is enough?
Yeah, that's a really popular question. So do we all understand what an umbrella policy is? It's liability coverage that covers you in the event of a lawsuit. So 90% of all liability lawsuits in the United States are motor vehicle related, either boat, automobile, things like that. So there's an accident, you're named at fault, whether you're actually at fault or not, you're named at fault, and then someone files a lawsuit to get damages. Unfortunately, the way it works in our country is that, let's say someone who works at a restaurant is coming home from work and causes an accident, someone's injured, the settlement won't be very big. They might find a lawyer and discover who's at fault, and they say, well, this person doesn't have any funds, so there won't be much of a settlement at all. But let's switch the story and say it's actually you that caused the exact same accident. Someone who could hire an attorney and do a process of discovery and find out, okay, this is a person of means. Now the settlement is going to be much larger. We're going to go for a lot more. So you're going to want to have an umbrella policy in place. So if the worst case scenario does happen and you're named and there's a settlement and you lose, that it's the insurance carrier that covers that and you don't pay. Okay? Liability claims have zero deductible. And so it covers court costs, it covers attorney fees and things like that. So how much is the limit? What do we need? This is normally the point that starts most of my conversations with new clients who, again, their net worth has exceeded $5 million or whatever their current carrier is willing to offer. And so what I recommend is you take a really healthy look at your net worth, or just think like a prosecuting attorney. If you were the attorney that was going to try and sue you, what would they see? What would they go for? And so you're going to want to cover your net worth, but then you also need to look at your exposures. Do you have do you have young drivers who are driving? Do you have several rental properties? Do you have properties that are in Florida? Do you and that sort of thing? And so you're going to want to make sure that you're covered for those things. So that's the conversation we would have, looking at your own personal situation and making recommendations in that way. And the good news is this: is that when you're talking about rates and premiums and things like that, liability coverage right now is relatively low compared to the coverage that you get. $10, $20 million liability policy. When you look at what it would cost to be like, okay, that's not what I would thought it might be. So it's actually pretty good.
Yeah. And ultimately, what helps you sleep at night So we've got clients who have the maximum liability coverage that we offer because they feel better about it. And then we have other clients that are fine taking on more of the risk, and they understand the implications. So whatever helps you sleep at night is also something that we like for you to think about. What is this experience that you want, and how do you want to protect your assets?
So, never having been through that situation, never wanting to go through that situation, if for some reason I caused an accident, do they have the ability to force me or you to disclose how much liability coverage I have?
That's
So
a really great question.
The question is, if you do get involved in an accident, does the plaintiff or the person who's trying to sue you have the ability to force your hand and have you tell them how much liability coverage do you actually have?
So I'm going to turn this over to you in a second. I've actually been reaching out to different attorneys and doing research to say, how can I protect my clients if they ever meet you in a courtroom? And that's how we start the conversation. And I ask questions exactly like that. On your side, how does it work on that side? And here's what I've learned. In Virginia, if the lawsuit is in Virginia and the settlement or the property damage and hospital bills exceed $12,500, which they always do, then they have a right to subpoena your liability coverage, and they can see what your coverage is worth. They can't subpoena all your properties and your bank accounts. They can't subpoena that unless it's a very extreme example. In some cases, they can, but that's much less likely to happen. So the answer is yes, they can see what your liability is.
But let's be honest, not much is private information anymore in this day and age. And so while Bart and I are not attorneys, we see this on a day-to-day basis, and
If you have, you're at your summer home and one of your guests or your grandchild or somebody drives your car and causes an accident, are they liable or am I liable? You're in my car.
Okay.
Right. So,
Yeah,
go ahead.
the question is, if you have a guest in town or a child of a guest or whatever, and they jump into your car and drive it and have an accident, who is it? Who's at fault for? Who is liable for that that accident? Whose insurance does that fall under?
So in short, it will always go back to the owner of the car. Whoever's name is on the title of the car can be named in the suit because it's your car and the insurance follows the car. But the driver can also be named in the lawsuit as well. So it can be both. And that was actually one of the questions that we had. But we're talking about liability now.
Yeah.
So we can continue talking about liability because I think you have some interesting information to share. But the question is, the answer is yes.
And
If
is
some,
that for every state? Or do different states have different rules about that?
yeah, that's a great question.
it's for every state. So the car insurance follows the vehicle, not the driver. So if you give permission to somebody to drive your car, you're ultimately going to be responsible. And then if they see or understand that you have some sort of assets, then they're likely going to go after it harder.
And the way I've learned is the way that these cases go is, let's say your grandson takes your car without your permission. You didn't even know. And then they cause that same accident. You know, is it still your fault? And the judge will say, did the grandson steal your car? And if the answer is, well, no, he has my permission, then he has your permission and then the lawsuit follows. But if your car is stolen, then that's a different story. If someone steals it from the parking lot at Heartwood just now and does some crazy thing with it, then that's a different story.
Yeah, so I actually had a situation like that, but regarding a boat. A client's son took possession of the boat without permission, ended up causing a fatality, unfortunately, even though the client stated that that the son did not have permission because he was their son and in the household. They were ultimately responsible, and their umbrella policy paid out the max, which was $5 million for that particular situation. Yeah, so.
Any other follow-ups on that? All right, we're getting close to being out of time here. I'm gonna ask one more question, which dovetails nicely on that, and then please, any questions that you all have, we'll finish up with that. So, how and when do you all recommend shifting children off of policies, both auto and other policies as they age? Like, what is
Yeah.
what is the recommended path for that?
Yeah. So I do want to say something real quick. So Bart and I see this stuff every day. So
Every
like
day.
I feel like every home's gonna burn down. Everybody's
gosh.
gonna. So like I did not want to scare anyone with this. We have great solutions for you. But I think if you want to answer the question on
We
that.
talked about this one yesterday.
Yes.
I like the way you worded it better. Not the way that everybody's house is going to burn down, but the other way.
not that way.
No.
Yes. So honestly, as soon as possible, when you can get comfortable getting your child their own vehicle and their own coverage, that will help to separate your assets from their activity. So you can pay for the policy. We don't ask who's giving us the money. So if you want to do it that way, but in order to do so, the child has to be the owner of the vehicle for them to have their own insurance policy. So if you still own the vehicle, they still have that vehicle, and that driver still needs to be on your policy. But if you can get them off, then there's some great benefits to that.
So basically, the sooner the better.
Yes.
Yeah.
Okay.
One question, if you're going to switch into Chubb, I have like probably a mid-level insurance, and they would only give me a certain amount of an umbrella policy,
Right.
like you had stated. If I wanted to switch, when is the ideal time to do that? Does it matter? Should I wait like a month before all my policies expire, or you can do it right away?
So
Yeah.
the question is, when can you switch, or when can you look at your insurance policies?
And you can do it today. You can look at it and switch it today.
Is that wise? That's a good thing to do.
I would say it's wise to have good risk protection as soon as possible without causing alarms or raising flags. It's happened several times even this year where I was talking with a new client and we were going to seal the deal on Friday. They said, let's wait till Monday. And then during the weekend, their daughter had a car accident. She's fine. But then there's we have to wait for months and months for the claim to settle before they can move everything over. So I would say just as soon as possible.
And your insurance company, I think.
Will rebate.
Will prorate.
Yeah.
Yeah.
Your current insurance company will prorate.
Yeah,
back.
they'll
I just went through
prorate
this
it.
Yeah.
the other day.
Yeah. So if you change coverage midstream, you will get a rebate of whatever premium
Yeah.
hasn't been used.
Do you, is there time?
Any other questions? There's something that Rachel had prepared that I think is, yeah.
So following up on what you said, name a warm state that'd be good to be domiciled in if you own property in Florida. I mean, what is a lower insurance premium risk state than Florida, I guess is my question.
Oh gosh, not many. Not many. Non-coastal, non-wildfire, non-earthquake.
I guess upper Louisiana, because we learned from Chubb yesterday.
Yeah.
Lower Louisiana is different. It's the only time I've ever seen that a carrier chopped a state in half.
What about Georgia or South Carolina?
Coastal.
Are you on the coast?
No, it wouldn't be.
Yeah. I mean, there's still
Yeah.
some great states where there's capacity, premiums are still lower, but honestly, across the board, every state is increasing rates around double digits right now.
Double-digit percentages.
Yeah, Florida, Florida's up even more.
Yeah.
31%, I think, is the average right now.
Yeah.
I had 125% premium increase.
Yeah. Yeah.
And got it down to 100%.
Good job.
I'm working with a client now who has a Florida home, a $4 million Florida home, and his premium increased from $20,000 to $50,000 on his renewal. And then we looked, we said, okay, let's just see what else is available, knowing that there wouldn't be anything, but let's just go through the process so you can see that we're working to show you what, and the next available one was $100,000. So the wisdom is if you have coverage now, and it's good coverage, it's good to stay there until things kind of start calming down. But we can always look and see what else is available. Yeah.
Time do we have?
Probably another.
Yeah. Yes, sir. Yeah, we
Is that
do.
enough?
This is really a really quick, good information I'd like for you to hear from Rachel.
Yeah, I won't go through this in detail. So this is a phenomenon we're seeing in the lawsuit world, in the excess liability world, umbrellas. It's called social inflation. This is a cultural phenomenon that's actually broadening the definition of liability. So what you as a person can become liable for, that definition is broadening. It also means an increase in the number of lawsuits. Everybody's suing everybody for everything, as well as an increase in the size of compensatory awards from juries and judges. So this is something to be aware of, and we find in our world with affluent clients that they are more prone to a larger, they're more prone to get sued, and the reason behind that is that there's this feeling currently, culturally, that people who have money need to pay for it. And so the vast majority who don't, they try to stick it real hard to people with money. Yeah. So just be aware of this. Something that's come up is the complex regional pain syndrome. There's more definition around what this is, more sympathy for it. And so this has come up with a lot of auto accidents lately, that it's almost like a phantom injury, but it is now defined, and you can put a dollar amount on what it's worth. And so this is causing pressure on carriers currently. We think that excess liability capacity is the next capacity to have challenges, like the property market right now. But yeah, so emotional distress and PTSD are now things that we talk about on a regular basis that we can put a monetary value on in a lawsuit. We have clients with a lot of high-powered luxury vehicles, and so they can go fast and they cost a lot of money. The social economic divide, that continues to grow wider and deeper, and so that is causing some more concerns around social inflation. So, and then is anyone aware of litigation funding companies? Have you heard of this? Yeah, this is interesting. We're kind of curious to see how this is going to play out, but basically it's an investment fund, and if you want to bring a lawsuit towards somebody but you don't have money, you can go to a litigation funding company and they can decide to invest in you, and they only get paid if you win the jury. But they're seeing this as a better investment because of the social inflation phenomenon. So interesting to kind of follow that. Okay.
And so in short, and again, I never lead from fear. In short, a lot of us think that our biggest exposure to loss would be if our home burned down. Mm-hmm. But in reality, our biggest exposure to loss is if we're named in a liability lawsuit, where it could reach multi-millions up there. So it's just, and the good thing is the solution is very easy. Mm-hmm. The solution is just have the right amount of umbrella policy, and then even if the worst case happens, it's absolutely fine.
Mm-hmm.
All right. Any other questions from anybody? Any Zoom questions? Okay. Well, Bart, Rachel, thank you all for being here. I'm sure
for having us.
If you got questions offline, they'll hang around for a little while. And again, thanks everybody for coming. Appreciate y'all being here.
Yeah, thank you.
Thank you.
All right. Thank you.
Could y'all bring